Good morning. I'm pleased to launch our 14th annual ULI PwC Canada Annual Trends in Real Estate program. My name is Richard Joy. I'm the Executive Director of ULI Toronto. Again, welcome. This annual event has become one of the most anticipated milestones of our annual calendar of events, a programming series that has grown to over 75 individual events in the past year. As you can see through the incredible attendance here, this is very much the case. First, I'd like to acknowledge and thank our annual sponsors, whose increasing and ongoing support has been at the foundation of our growth and impact in the Toronto region. So thank you to our annual sponsors. Their names are being, the companies are scrolling across the screen behind you. I also want to thank our 30 table sponsors who've electrified this year's event with your generous support, selling out the tables nearly 2 months ago. Amazing, amazing. Thank you to all of you. Very briefly, I want to take a moment to bring your attention to a major event that's on our horizon just under 3 weeks, and it's our third major symposium on November 17th. We're hosting at the Evergreen Brickworks. Called Toronto Urbanism, this year's Conference on Wheels seeks to better define the many unique city building stories of the Toronto region, and we have a short video to help animate that point. This symposium has taken on added importance as the Global Urban Land Institute recently announced that Toronto will host the major 2020 spring meeting of some 4,000 international attendees. With a global audience arriving in Toronto in just over 18 months, we want to showcase our region and our world's city building talent that reside here. In this context, our November 7th Toronto Urbanism Symposium has become something of a dress rehearsal as we dig into the amazing urban narratives that define our city region. So we hope as many of you as possible can join us for what will be a very rich day of education and dialogue as we get ready for spring 2020. And with that, it's my pleasure to turn the podium over to Quadrangle Architects co-founder and member of the ULI Governance Committee, Les Klein, who will introduce our keynote speaker. Les.
Good morning and welcome. I'm Les Klein. I'm a co-founder and principal at Quadrangle Architects, and I'm also privileged to speak to serve as a member of ULI's Governance Committee. Before we begin, I want to take a moment to introduce you to the newly renamed ULI Toronto Kirtner Leadership Program. The Kirtner Leadership Program is sponsored by Quadrangle in memory of our partner, Brian Kirtner. It's an 8-month program led by former City of Toronto Chief Planner Paul Bedford, in which participants attend seminars involving key stakeholders from the private, public, and nonprofit sectors, and are tasked with solving existing real-life land use challenges in an effort to help a local community achieve its maximum potential. The program participants are given the opportunity to work collaboratively within a multidisciplinary team of experts and engage with the brightest industry professionals, as well as employers, grassroots organizations, and members of the local community. This program also reflects many of our partner Brian's passions, including city building, mentorship, and collaboration. And Quadrangle's support of this program and ULI as a whole represents our commitment as a firm to the type of nonpartisan, open, and collaborative exchange of ideas that ULI nurtures to the benefit of our industry, our city, and our society at large. Next week, we will all cast our votes for our respective municipal governments, who will sit for the next 4 years and represent our interests. And in just over 2 weeks, the U.S. will hold what many consider to be crucial midterm elections. In this era where diatribe has replaced dialogue, where tribalism has replaced democracy, and where tweets have replaced meaningful debate, we need forums like ULI where ideas can be safely, thoughtfully, and respectfully heard, discussed, and put into action. For those of you who are not yet members of ULI, please consider joining us. On that note, I would now like to introduce this morning's keynote speaker, PricewaterhouseCoopers Director of Real Estate Research, Andrew Warren. Andy is an active member of the ULI Research Forum, and for the past 5 years has researched and co-authored the much anticipated and widely disseminated Emerging Trends in Real Estate report. He is a frequent speaker on issues affecting the real estate market, and he also forecasts market performance for PwC's Real Estate Investor Survey. And he has 30 years of experience in all aspects of commercial and residential real estate research. Prior to assuming his current role, Andy served as the Managing Director of Real Estate Research for Principal Global Investors, a top 10 institutional real estate manager in the U.S. As always, we have a packed program today, so without further ado, I'm pleased to invite Andy to the podium to share his insights with us. Andy.
Thank you. That was a very, very kind introduction, but next time leave the 30 years out because that makes me a little old, I think. But it's great to be back. You know, we're 2019. Think about what 2018 was like. And we were standing here a year ago, a little less than a year ago. Did we know we'd have a trade war? Did we have all the noise coming out of governments on both sides of the border? But really, when you speak to the people in the real estate community, the ability to tune out kind of that excess noise has never been better, and kind of just continue to go on and continue to work and get things done. And so at a point in the cycle where it's been going on a little bit longer, markets are fundamentally pretty strong. The market has actually had time to kind of sit about and think about new ways to do things. And I think that comes out in this year's trends as we kind of look at, reinvent, rebalance, rethink kind of things that we can take advantage of at this point in the cycle to prepare ourselves for the next 10, 15 years. Once again, we had great participation, so I thank everybody who filled out the survey. We had over 2,400 people surveyed or interviewed. We had over 400 from Canada giving their opinions on both the Canadian market and the US market. So really great participation, and it wouldn't be possible to do this without everybody, so thanks very much. And this is the 40th year of Emerging Trends. So it's been going on for, at least longer than I've been in the business, so that's always a good thing. And we asked people what they thought the biggest change was over the last 40 years, and without a doubt, whether it was a Canadian response or a US response, it was the global financial crisis. Didn't matter if you'd been in the business 10 years or 40 years, that was the number one answer by far. But the other ones that kind of stood out were really related to this maturation of real estate as an asset class. You know, the availability of information, the asset class being accepted by institutional investors and global investors. Then finally, you know, adding the REIT structure so that it became more mainstream. Individuals could participate in the market. So those kind of things all took place, driven by technology, kind of adding a change there. But then we asked the question, okay, that's what you thought happened. What do you think's going to happen? We kind of got some similar things. Technology implementation, which we'll talk about a little bit later. You know, autonomous vehicles. Space utilization changes was on both lists. We're continuing to change the way we use space, the way our tenants use space. And then, you know, artificial intelligence, interest rates are going to go up. Just some things like that. So it's going to be probably a very exciting next 40 years in terms of that. And you sit around and you think, you go back and look at some of the older reports, and we kind of thought, okay, 40, it's all downhill from here. We've kind of hit that point. Although we've chosen to take a little bit of a different tact. We're going to keep calm because 40 is the new 20. So, you know, you don't see those over-the-hill mugs anymore for 40 like you used to. So it's kind of changed. So we feel good about the next 40 years. Market sentiment. Last year, very good. You know, excellent was at 19%, good 58%. People felt pretty good about where we were at that point in the cycle. Now, you know, if you think about it now, would you feel better looking at next year? Not much of a change. Kind of bodes well, I think, for the idea that the market's going to continue to move on kind of the way we expect. Maybe a little less on the excellent, but the 4 people who thought it was going to be poor in 2018 have now switched. They now think it's going to be fair. They've moved up to that. So that's a good sign. So, you know, we thought, well, okay, let's compare Canada to Toronto. There's the Canada numbers that we just looked at. Here's the Toronto numbers. Toronto's a little more restrained in their outlook. Excellence a little bit lower. Good is exactly the same, a little more fair. I'll let you determine kind of where you think that's at. I think it's probably because as a global city, kind of in a little different position than maybe other people across the country. Here's our words that we introduced a couple of years ago. I forgot these were going to bounce in, so I'll get to them right now. But the one that stood out this year was kind of the evolving. That's new. That hadn't been on our list the previous 2 years that we asked for it. So it was kind of interesting to think about the market's here, we're talking about all these changes, and we're going to look at things evolving, getting better, doing things more efficiently. I apologize. I promise I did not sample any of the new legal products last night, and that's why my mouth's dry now. And also overheated came up. You know, it's the first time we've really seen that, and that came up in both the Canadian list and the US list. So are we really worried about getting overheated? But we kind of think maybe the market is at a point where you at least want to think about that. And then number one is always competitive, and everyone in this room knows how competitive the market is. So what are the trends that we kind of think is going to take over in 2019 and beyond? You know, rebalance. We're going to have to get creative, find new ways to do things, maybe look at structuring portfolios a little bit different. Reinvent. I think this is a big one. This is one that we're going to talk about today, and I'd be very surprised if we're not talking about it in next year and the year after that as new things develop. It's really about meeting what the customer wants. And real estate as an industry is finally beginning, I shouldn't say finally, but is really seeing the value in that. They're looking at the people they work with and taking their cue from there. And then finally, rethink the puzzle in terms of housing affordability. It's ongoing. It's spreading across all of North America. You know, markets in the U.S. that we used to think of as very affordable now kind of have affordability issues. So it's going to be kind of a continent-wide issue that needs to be thought about and worked on. And then we're going to look at some of the potential implications from that. Rebalance, last year we kind of looked at, so if you're going to rebalance, what would you buy? These are the recommendations from our list. Moderate income apartments ties right into that housing affordability question. Fulfillment, e-commerce. Age-restricted housing, medical office, tied into the changing demographics. So we've kind of got an idea here in terms of we're addressing housing affordability, we're looking at demographics, and then we're also looking at the transformation of retail as an industry. And then what would we sell? The big one that stands out here, and I'm going to offer a little qualitative counter argument to this, is when you get to power centers, and 72% of people say we should sell, is that a time to think about buying? Or is it too early? But talking to people, you began to hear a lot of conversation about looking at power centers that maybe have already repositioned. They've gone out, the anchors have downsized, the potential to do mixed use. That's something we talked about last year was placemaking. Some of these power centers offer that opportunity to add residential, maybe add office, maybe add senior housing to that mix. So maybe that's something to think about. And the others, I think, kind of get swept up a little bit in this, the retail frenzy that we hear about with outlet centers, which just a few short years ago were on our top buy list. They've kind of jumped down there, so I think that's a little spillover from that. So if we think we're at the top, are we really worried and we think maybe the market be overheated? What do we think about pricing? You kind of look, if we look across all property types, the average opinion of values being overpriced is only 32%. So it's really not that bad. Luxury hotels are at the top of that list. High-income apartments, I think we kind of feel like, okay, maybe that is at a point where it needs to take a breather. Power centers kind of down there that everyone wants to sell, but they're overpriced, so I'm not sure who's going to buy. And then Central City office, where a lot of the activity has been. So kind of some ideas where you think, okay, I may take a pause. If we look at the flip side of that, okay, underpriced. Is there something that looks good right now? A little smaller number. And not surprisingly, we also have regional malls showing up on that list. So it's not so if I took the middle of this, we'd see a lot of that where people think every property type is fairly priced. So things look pretty good from that perspective. So rebalancing is going to be a bit of a strategic play for each individual investor. So new opportunities. This is going to be the introduction to the cities in the U.S. And I put these up there because these were the top 20 markets from the U.S. report. And you'll notice you've got Orlando, Raleigh-Durham, Charlotte, Dallas-Fort Worth, Austin, 2 Florida markets, Orlando and Tampa. These aren't our typical gateway cities. People are continuing to look at these smaller markets and thinking, okay, maybe there's opportunity there that might be a little less competitive than it is in some of these other markets. Or on the other side of this, it's not just a competitive play, it's also that these markets are growing faster. They're more stable than they were. That kind of the horizontal graph kind of shows the stability of the market during this cycle compared to previous cycles, and their growth rate's significantly higher. Boston, Washington, D.C., Brooklyn, Los Angeles were really the only gateway markets that kind of showed up on this year's list. So maybe it's time to kind of look at other opportunities in markets that haven't really thought about before. And then what do we do with all this information that we have? Can we unlock some insights with the analytics that are now available to us that we didn't used to have? 5 or 6 years ago when I first started doing this, we talked a lot about big data. And we also talked about the concept that we only utilize less than 10% of the data that we collect. Well, if we look at this and we go across, we're getting into that maturity concept of what we can do with the data. We have it, we can clean it now, we can put it in reports that we want, but we were really on the kind of the precipice of really starting to use this predictive and moving into this action and putting it into the analytics that we want to use to get that information. And this applies to buildings, it applies to investments, it applies to portfolios, kind of all putting it all together and using these tools. So reinvent. What are we going to reinvent? And this is the part that I get the most excited about when we think about the real estate industry, because it's typically been, very much a relationship. It's still going to be. Individual knowledge has been highly valued. It's still going to be. But now we're beginning to see investment in other aspects. Investments in real estate related technology are up significantly, 41% over the last 4 years in terms of dollar amount and also in terms of the number of deals that are being done. And we might think that's just money being thrown after, maybe an attractive asset class. But it's also being done by market participants. So there's actually a real reason behind that. And the real estate as an asset is getting large enough that these firms see the opportunity, think it has legs, think it can continue to last. So expect this to continue on over the next few years, if not get any higher. And what does that mean, technology? Well, one thing that we talk a lot about is artificial intelligence. And we're kind of looking at AI, which is artificial intelligence, impacting PI, which is personal intelligence. And anytime you bring up artificial intelligence, you get the debate, well, it's going to wipe out all of our jobs, we're all going to be out of work, the robots are going to be doing it. Well, it's not really the case. Most of it, I'd say the odds are very great that all of us will still be working here 10 years from now, unless we choose to retire. But are the tasks that we do going to be the same today as the ones we're doing? Or in 10 years going to be the same as they are today? I don't think so, because this is where artificial intelligence really begins to add value. And you look at some of these physical tasks, customer service, intellectual tasks, all kind of moving up that chain. You've got, autonomous vehicles kind of fall into that physical task. They can park themselves. We don't have to do that. Customer service. I think it's fascinating that they've been able to teach a machine to leave us as unsatisfied as talking to a real person. That's not easy to do. And then intellectual tasks, moving up the chain where they're using supercomputers for medical diagnosis and absorbing a lot of information, putting things together. We asked the question this year in the survey because we were interested in the idea, what do people think could be the next disruptor? And no surprise, construction technology comes in at the top. That's something we've talked about in this room in the last couple of years. The use of construction technology to help against materials cost increases, labor cost shortages, all of those things. But then you kind of get some others, big data analytics, which we talked about, the sharing economy having an impact. What surprises me a little bit is that blockchain and drone technology are kind of a little bit lower down there. Maybe that's going to take those a little longer, but you also hear a lot about those. But it's one of those things that maybe we haven't identified yet, how much of an impact they can have. And there is some historical precedent for missing things. Now, I mentioned emerging trends have been around 40 years. This was probably not our finest moment. Put this up here. In 2004, they asked the question about the impact of technology on the different property types. 70% of the respondents felt that technology would have little or no impact on retail demand. Well, that certainly hasn't worked out that way, so we're trying to avoid having one of those other items on that list show up as the one in 15, 20 years they come back and say, hey, they missed this completely. So what is prop tech? And it's one of those terms, and I know George and the panel can talk about this far better than I can, but prop tech is such a large area, and it touches so many different things, and they're all kind of intertwined. And this is where the momentum in the real estate industry is beginning to take off, is kind of that interaction between the two. We have prop tech, we have fintech. You put those together, you get the real estate finance technology area, where we're touching that. We have construction tech. We have the collaborative economy kind of pushing up from the bottom. Tenants want this, they want to be able to do this, so you provide it. You kind of get smart real estate, so it's all kind of working together to kind of push this forward. And it's pretty safe to say that the 10-year, we're at the 12th year of the Canadian content. When we get to 20 years in the next 8 years, I think this will be something that we're either looking back and it's mainstream, or we'll be looking at the next change. So it all kind of comes down to, why are we doing this? Well, it's to make our tenants happy. Everybody wants to attract workers, they want to keep workers, Labor shortages are showing up across all of North America, something everybody's thinking about. So landlords are having to offer more to get tenants and keep tenants. We've got 81% feel that the amenities that they offer are the way to do that. And this kind of gives a quick list of things: full-service cafeteria, showers, fitness facilities. You know, somebody made the comment at an earlier presentation that they thought the showers must be related to the fitness facilities. Well, it's not necessarily so, because if you have people riding their bikes to work, the showers are a very nice amenity to kind of offer with that. Don't see this slowing down at all. It may change. You know, this list of things that people want is going to, you know, evolve as we go through it. But this kind of concept of making everybody happy is going to continue on. We're getting to the point, this may be the talent we're interviewing for. And in the US, this may well be if we shut down our borders and don't allow anybody else in, because they'll come in through that. But this isn't really, you know, hiring aliens going through. That's kind of a cute concept. But when I look at this, the concept hits me. Sometimes the guy on the other side of the desk with the suit on is looking at the person on the other side and thinking, wow, what planet is this person from? And that change of kind of how people want to work, the different generations kind of going through things. We're still in that concept that we talked about last year with we've got 4 different generations active in the workforce now. Keeping everybody happy and doing things the right way is going to be extremely important going forward. So is there anything we can rethink as we kind of look at this? You know, housing affordability is an extremely complicated puzzle. You've got to first identify what the real problem is. You know, are we trying to solve, you know, housing affordability for people that just can't afford it? Are we looking at the working age population? Do we want to keep housing in that range? You've got to get all the pieces right. You've got to get the demand side identified. You've got to get the supply side right. You've got to get the economics kind of working together to make that work together. Then the one thing that kind of gets lost in the wash sometimes is, what about the unintended consequences? If I do this, where does it push out here? And that's something that's very difficult to get a handle on. You've got to think 3 steps ahead, and then you're probably still not going to be right. So then what are the contingencies for how do we make that work? But you know, affordability has really become an issue, as I mentioned, all across North America. And a lot of cities are looking at ways to kind of make that fit. And if you don't solve it, or even if you do solve it, there may be people leave. In that list of US cities I mentioned, one thing that's driving those is there is a lot of in-migration from the gateway cities to those markets. People are deciding to move. So we kind of looked at Toronto's migration patterns, and you see the orange and the yellow, which are international in-migration and province to province in-migration. Still very strong, very positive, but kind of looking at an outlook of roughly a little over 20,000 people leaving each year, moving to another city. What does that do? Why are they leaving? Well, this was a conversation we had during the course of the interviews for this year's emerging trends, and somebody said, okay, people are, millennials are, they're 30, the oldest are in that 35, 36 range. Where each year there's going to be more and more turn 30. Do they start having children, forming households? What do they look for? Well, they look for more space. They want schools. They want proximity to family, perhaps. And then they're thinking, okay, it needs to be affordable, so they're moving to these metro areas where that's available, or they're moving to suburbs in those metro areas. Once they move to those metro areas, they don't want the same thing that maybe their parents' generation wanted. They still want to have access to amenities. Walkability hasn't gone away, or if it's not walkable, it's got to be very ease of using the car. You can pull up, park in front, pull out the other way. So they're doing that. And they want available transit so they can go into the city where they came out of for entertainment opportunities, or still work for a lot of these group. They get out there, so you've got to have the right residential, you've got to have the right retail, the right services, so that follows behind. These areas get more attractive, which brings more people out. Then do we get to the point where we eventually get workforce to move out there? Or if they're not already there, you have employers going to where the workers are. And one conversation that I've had for the last 2 or 3 years with groups when we're doing the interview process is when you talk to younger people, they love working in the city, but they would really love the ability to maybe work out in the suburbs where they live 2 days a week or something. So do we see that kind of trend continue? And I think maybe we do, and it's going to be something that won't happen immediately, but over time, in the next 10 years, when the millennial generation continues to go through this process, that's where it's going to end up. So best bets, issues to watch. This could be 4 or 5 slides in and of itself, but we kind of kept it down a little bit. Fulfillment, nationwide across Canada and the U.S., fulfillment, e-commerce, still on the rise. Doesn't mean the end of retail, brick and mortar. Just means that we're starting to think about, this is a piece of the entire consumer package, and it's still extremely popular, not overbuilt. Actually, it's evolving as well as from what it was as we look at large distribution centers to serve multiple markets, to urban industrial that serves, same-day delivery or 2-hour delivery. Multifamily market ties in very closely to the affordability, and senior housing, a demographic picture where there's a lot more of us getting older. Where do we want to live? What kind of amenities do we want? Where do we want to be? Big choices there. Issues to watch, interest rates. Clearly, the general consensus is rates are going up, but how much are they going up? How fast are they going up? Are they going up for the right reasons? Something to take into account. And then finally, tariffs. Where does this all end up? I was watching TV this morning on the way in. They're now discussing, will we, in our lifetime, see a resolution to the China-U.S. trade war? Don't know. It could be that long of fact, and it's going to change the way we all look. And then I'm sure by the time you have elections coming up, by the time we get a month or 2 out, there's going to be another group of items on there to kind of fit that list. So that's kind of where we're at with 2019. Very stable, an evolving market, pretty dynamic for where we're at in the cycle. So it looks good. Everyone's doing a fantastic job, and hopefully I've been able to lay out a groundwork so that the panel can kind of answer the nitty-gritty questions involved with this. So once again, as always, it's great to be here, and thanks very much for letting me attend your meeting.
Good morning. My name is Signa Leask. I'm a partner at Castles Brock and co-chair of ULI Toronto's program committee. And on behalf of the management committee of ULI, it's my pleasure to thank Andy once again for presenting the annual trends report here in Toronto. Our large audience here today is a testament to the high level of interest in your report, written in cooperation with your colleagues here at PwC Canada. And specifically, I want to acknowledge the lead PwC Canada senior advisors of the Canadian chapter, Frank Magliocco, Chris Potter, and Miriam Gurza. It's now my pleasure to introduce Nadia King, partner, PwC Canada, who will introduce and moderate our special Toronto panel as we further explore the emerging trends in real estate. Nadia is a leader of PwC's private company services practice in the GTA. She collaborates, engages, and provides practical advice and tangible solutions that help owners and leaders of private companies achieve the returns they are looking for while engaging and developing her team members. With nearly 20 years of experience, Nadia's main focus areas include serving clients in the real estate and retail and consumer sectors. She also has a significant portfolio of clients in the technology and not-for-profit space. And of course, most importantly, she's a member of ULI Toronto's Governance Committee and a WLI Women in Leadership Champion and past treasurer of ULI Toronto. And I'll turn over to Nadia.
Thanks, Signe, and good morning, everyone. I am pleased today to be joined by our esteemed panelists. I'm just going to do a brief intro on each one. So to my immediate left, we have Michael Turner. Michael is president of Oxford Properties. Oxford is a leading investor, manager, and developer of high-quality assets with investments in office, retail, logistics, multifamily, and hotels. Oxford's $51 billion business comprises one of the world's most eminent global portfolios, operating in 17 gateway markets in 8 countries around the world, and invests across the risk spectrum. Next to Michael, we have Cheryl Schindrick, who is Executive Vice President, Land Development at Geranium Corporation. Geranium is a Markham-based land developer and home builder, which focuses on creating places that are planned, executed, and designed with the sensitivity and respect of the environment, the local neighborhood, and the families who will call them home. Prior to joining Geranium in 2003, she was the manager of planning services at a Barrie-based planning and engineering firm. Cheryl is the first vice chair of the board of directors of BUILD, member of the executive committee, and co-chair of the Simcoe chapter of BUILD. She's also a past examiner of the Ontario Planners Institute and vice chair of the board of directors of the Unionville Home Society. Next to Cheryl, we have Fong Enyo, who is the director of New Homes Research at the Altus Group. For the past 17 years, Fong has been involved with research and analysis for over hundreds of new home developments across the GTA, the Greater Golden Horseshoe, Vancouver, Calgary, and Edmonton. He is a regular contributor to BUILD's Toronto Builder magazine and serves as co-chair of the Low Rise Program Committee, as well as a member of the High Rise Program Committee over at BUILD. And finally, we have George Karras, who is founder and CEO of R Labs. R Labs is Canada's PropTech venture lab focused on creating and accelerating the next generation of technology companies that will hopefully help solve some of the major problems in the housing and commercial property markets. George is a mentor to emerging industry leaders, the past president of Toronto NAIOP, and serves on the advisory board for Optrust Real Estate Group, Butcon Limited, and the Dorsey North Pickering project. Welcome to all of you, and thank you for joining us today.
Thank you.
Now, I know you've all had a chance to read the report as well as hear some of the comments from Andy. What I'd like to do is give each of you a couple of minutes to reflect on what you've seen and heard to date. So Michael, because you're sitting next to me, why don't we start with you?
All right. I mean, I think Andrew sort of said it all, and the 200-page report kind of says it all in a lot more detail than I could share. So I could just summarize and say our Canadian business is doing pretty good. Markets like Toronto and Vancouver are doing exceptionally well, but even in sectors I think that have struggled, so let's take Calgary office as an example. You know, I feel like the market has bottomed, and I think our leasing folks do as well. So I think we are in pretty good times right now in terms of fundamentals. We're obviously going to keep an eye on supply, and we will be doing the retool, rethink, reimagine as were the major themes that Andrew talked about.
Excellent. Cheryl?
So I would say on the housing market, I'm really pleased that the report has joined the voices calling for action on the housing supply situation in the Toronto region to address affordability. In response to the escalating house prices, so far government actions have been overly focused on the demand side, and we've taken our eye off the supply ball and need to get it back on. So I'm really happy to see the report focused on that. On navigating change, not sure we're really ready for the 2 huge arriving demographic tsunamis. A lot more older people and a huge wave of family formation and first-time buying millennials, now the largest generation and made up mainly of the children of the boomers. On prop tech, real estate industry is doing it, and now we need government to embrace technology and lubricate the approvals process to deal with development and demography. On talent, the current approach to apprenticeship and community college programs is not really adding up for our industry. There's a skills gap in the building construction sector, and we need to address this as part of our strategy to fix the supply problem. Our region is expected to grow to 9.7 million people by 2041, and that's about 115,000 new residents per year. We're going to need 55,000 housing units to be built on an annual basis, and we're barely doing 40,000 units per year. So we're falling short of that. We're getting a little further and further behind, and I'm confident that we can do it, but we've all got to put our shoulder to the wheel and figure out how to make that happen.
Great, thanks, Cheryl. Fong, over to you.
Thanks, Nadia. So for me, there were a couple of key takeaways from the report, and the first was the consensus that supply is a real problem, to Cheryl's point, and not just on the residential side, but on the commercial side as well. I don't think that's groundbreaking news. It's something that's been well talked about for a long time now, but it's also a problem that's not going away anytime soon, and it's got some real implications on things like affordability. And the second takeaway was the importance and the role of data. There was a great quote in the report that said data analytics will become a much bigger part of the business, and I couldn't agree with that more. You know, it's hard to make informed and actionable decisions when you don't have good data or the understanding on how to interpret that data. That's obviously a space that we're pretty active in, and we see a lot of opportunity for different applications of the data beyond, you know, the traditional uses, and we think that's really going to help drive the industry forward.
Excellent. And George?
So I think, echo Michael's congratulations to PwC. I think, you know, when you do something over and over again for 40 years, you get really good at it. And I think, you know, distilling all of the conversations in a 108-page report, for me, going through that again this year, there are two themes in the cut lines that I think were really important. The first one is new era, new thinking required. And I think that kind of means three things. I think it means you're seeing that in the maturity of the real estate asset class, perhaps in its current business model. You're seeing the coming changes through technology that are now disrupting that current model, in fact, actually adding new models to that. And the other one, I was mentioning this to Andy, is these little pearls of wisdom that are just lost in this 108-page report, and one is climate. And you look at this staggering number of $300 billion of damages through climate events last year, which is 10 times what it was 10 years ago. Evidenced even here in Toronto with the floods that we had. It's a small look at what is ahead and the problems that we face. The other theme that I thought was really important was the pace of change is too fast to comprehend, and that felt like it was one of those people out there who was just reaching out and saying, "Stop the ride, I want to get off," because there's a lot of changes that are happening through technology. And you looked at the comment of technology in emerging trends in real estate, 3,000 prop tech companies, all of them going out and disrupting some area of our business. But what's not in the report is emerging trends in technology outside of real estate. And if you look at what's happened in 2018, it's pretty eye-opening. And you know, whether you're looking at Boston Dynamics' robot doing backflips like a gold medal Olympian, or you're listening to Google Duplex and its AI making phone calls for you with natural English language, booking your appointments. The rate of progress in the technologies is impressive. What's also important is the flank that it's left exposed for us. And that's very evident now in cybersecurity and the damages that you've seen in Facebook, you've seen in British Airways. Even the township of Wasaga Beach got held for ransom with Bitcoin this year. So,
And Midland.
So things are different. And so depending on, you know, how you look at it, you know, real estate is operating now in a 1.0 world. The world is clearly operating at a 3.0 operating system, and we need some upgrades in our industry.
Absolutely. Well, thank you for that. So you've all touched on some great themes and some thoughts that I want to delve into a little bit further. So the number one theme that we actually heard from all of our respondents, and Andy touched on this, is the affordability concern. It continues to be a concern and is very much top of mind for a number of our respondents. So when you look at affordability, it really boils down to a supply and demand curve. So if we look at the supply side of things, a number of our respondents said, well, if you increase supply, that is going to eliminate or reduce a number of the affordability concerns that we have. So Cheryl, from your perspective, can you go through some of the main supply issues and maybe some potential solutions to help us solve the affordability issue, particularly here in the GTA?
So over the past 10 years, we all know there's been a paradigm shift in the Toronto region toward urban containment and intensification. But at the implementation level, we've been dogged with outdated and opaque regulations. Bureaucrats gone crazy with rules trying to figure this out, which has added time and cost to the process, and all of that ends up in the price of housing. The messaging around what is our supply has been very confusing. It's been, some people would argue, ideologically based. The upshot of it is it's caused a lot of confusion. There's designated land, there's service land, there's housing units. What is it? What do all these numbers mean? I think that our psyche has been confused by all of this. At the same time, critical infrastructure that's needed to support growth has been suppressed by layers of regulation and, in some instances, a one-size-fits-all set of rules. And meanwhile, we've turned a blind eye to whether housing, the market was actually being properly supplied. And combine that with the changes at the OMB and the LPAT, don't count on the LPAT to solve this problem anytime soon because we're figuring out how that system works. We're actually going to court to get answers to questions, simple questions around the functioning of the LPATs. So in terms of the fix, I think that first and foremost, we need to accept that there's a supply problem. And on that, I think we're there. There's enough people talking about this and looking to try and figure out what to do. We need to tackle government taxes, charges, and fees on housing because they're mounting and they all end up in the end price of a home. Again, make sure the infrastructure is there to support development when we need it. There's all kinds of environmental assessments sitting on the books that need to be expedited, and that's easy to do with the will to do it. The red tape has become strangling, and so we need to look at that in a very sincere way and streamline every possible process. And then somehow instill a culture of excellence and a commitment to the delivery of more housing in the region. So I would leave you with those thoughts.
Okay. So I think there's a definite undertone of government policy, I'd say, in some of the remarks I think that I'm hearing, Cheryl. And I was reading a Build report that actually highlighted that anywhere from 22 to 25% of the cost of a new home represents government levies, which is, what for me was a rather staggering number. So Fong, from your perspective, any thoughts in terms of how government legislation and the role that they play in order to attack the affordability issue?
It's an important issue. I think we could probably debate that all day up here. I think the one thing we can agree on is that government has a pretty significant role to play in improving the affordability crisis. And one of the key ways that they can do that is through ensuring or creating an environment where there's enough supply, right? And based on our numbers, there's clearly been an imbalance between supply and demand for quite some time now. And if I could throw some stats to kind of support that, in the GTA, as an example, we estimate there's a need for monthly inventory, remaining inventory, of somewhere between 25,000 to 30,000 units of inventory to maintain a quote-unquote balanced market. The last time we were at that level was November 2015. Currently, we're at about half of what we need. you mentioned, or the article mentioned, the government favors high-rise, yet a lot of consumers want low-rise, right? Low-rise inventory, when the growth plan was introduced years ago, at that time it was around 16,000 units. We're now at just over 4,700 units of inventory on the low-rise side. Of that 4,700, almost half, 45%, are in projects that have an average price of $1 million or more, right? So likely beyond the affordability reach of a lot of buyers. Less than 10% of that inventory is in projects priced less than $700,000. So add in interest rate hikes, tougher mortgage qualification rules, and it's becoming more challenging. On the high-rise side, on the condo side, you mentioned the government charges, Nadia. Right now, it's averaging about 18 to 22% of what it would cost a developer to build a typical condo in the GTA. That cost has risen by 138% since July 2013. It's going to increase again in 2019 and then further in 2020. So that's going to continue to put upward pressure on the average condo prices, which since 2016 has increased year over year as high as 40%. And right now we're pushing close to $800,000 on average for condo, and that's supposed to be the more affordable option for a lot of people, right? So until we get better at addressing the supply issue, whether it be through improving the approvals process for developers to get projects to market quicker, or providing relief on charges. Until we do some of those things or make some sort of changes, it's going to continue to erode affordability for a lot of buyers.
So really, the stats are really showing that we do have an affordability
100%.
issue. It's not just what we're reading in the papers. It isn't fake news. It really is an issue.
Is the newspaper all fake news?
I said some. I stand corrected. Thank you, Michael. So we've talked about locally in terms of what we're seeing. Michael, Oxford has a global portfolio. Are you seeing anything from an affordability standpoint that other regions are using to address this issue that maybe we can apply here at home?
Yeah, so the phenomenon, and I think Andrew alluded to this, about affordability is really an issue in every city that we operate in around the world. And the particular detailed sources of what are the challenges are unique to each city, but at the end of the day, they're high barrier to entry markets, people are moving there, and it's hard to make the math work and get things entitled in an efficient manner. I think New York offers some pretty good examples about ways that New York City has used property tax policy and property tax tools to incent the marketplace to deliver an affordable component. And New York can't be pointed to as housing's cheap, but you can imagine how much worse it would be for certain segment of the market were it not for these policies. And some of them have been in place for 20 years and they're very successful. So the models to emulate exist elsewhere in the world, and we have to find a way to sit down with government and just go through some simple math and just show them, the following set of criteria works and the following doesn't, and hopefully find a way to work with government collaboratively just to create the conditions to incent the market to deliver supply. This is a supply issue, there's no doubt about it.
Absolutely. So I think in a lot of the responses, we're hearing a lot about government policy. George, from your perspective, is it all about government policy, or are there other ways that maybe we can address the affordability issue?
So I think on housing affordability, I would go back to that theme, new era, new thinking. The thinking that got us to this problem is not going to be the thinking that solves this problem. So I think you could use a quote from perhaps one of the best real estate minds of our time, who I saw last night, Phil Dunphy. And Phil's line was, some people think you're part of the problem or part of the solution. I think you can actually be both. And you look at it from government policy, and it is absolutely both. There's no one in charge, and that actually might be a good thing. So one level of government introduces one set of policies, creates another problem, another government does this, and we repeat this. And I think, so yes, government policies are absolutely, helpful and part of the solution. Ultimately, what that might mean is it gets us to the starting line quicker. But I think the era of innovation and opportunity, evidenced in one of your top tech impacts, is in construction. Construction globally accounts for roughly 13% of world GDP. It has had a 1% increase in productivity over the last 20 years. It is time, and there are initiatives that are taking place in both methods, in materials, and labor that all have to come together to actually deliver housing in a more efficient way. And I think also on technology, you can attack that housing affordability problem through one very physical set of technologies, but I think the digital and the business model ones are also interesting to watch. And you're seeing that in fractional ownership, and you're seeing that in co-living, which is kind of a bigger deal in places like New York, London, and San Francisco, and I think we'll probably see our first one in Toronto here in 2019.
Okay, no, that's great. So I want to talk a little bit about innovation, because we talk about innovation and technology really sort of interchangeably, that they really help one another. One of the things that I actually found fascinating this year when we were going through the respondents' results was that particularly here in Canada, there were a number of people that thought technology was really going to impact their business going forward. And it's really a theme, and Andy went through that. But that being said, the sheer number of people who actually didn't think technology was going to impact their business was not negligible. It was actually quite large. So it's something that I just want to talk a little bit about. Last year, we had talked a little bit on the panel about prop tech. Andy has covered it off a little bit in his presentation. So George, if you were to summarize it, what is prop tech to you? And in your opinion, do you think it's going to impact the real estate industry going forward?
So, time makes fools of us all. So that quote in 2004, I mean, looking into the future, I think what prop tech actually means, time will tell. And there's lots of different definitions of it. I think if you try to simplify it, what it means is the changes in how we invest in real estate, how we operate real estate, and quite frankly, how we use real estate. So I think you can think of that word as an umbrella that will capture kind of all the innovation that's taking place at the intersection of real property and technology in the decade ahead. Our numbers that you showed here, $5.2 billion invested in prop tech. That's 50% more than it was last year. Global venture capital is up 28%. I think you're actually might be seeing the emergence of a seventh asset class in real estate with this, and I think it's going to have a profound impact, and we need it to solve some of the problems that we now face.
No, absolutely. So if I were to tweet what prop tech is after this, I should say it's very multifaceted, and stay tuned.
Let's invent it. Is the
All right,
point.
perfect. I'm gonna get you to help me post that later. So because it is very multifaceted, I do want to talk about one of the industries that is very much related to some areas of real estate, and that's retail. So online retail sales in Canada only really represent about 10% of total retail sales currently. So Michael, from your perspective, unclear where that's going to go, whether that's going to increase or not, but if that did, say, get to a 20% number, any thoughts in terms of what are the changes in terms of the needs and the uses of real estate going forward?
Sure. I mean, I think it's not a matter of does it go one way or another. It's pretty clear that e-commerce sales are growing significantly higher than traditional analog in-store sales. And in markets like the UK, there's already 20 to 25% penetration in online sales as a percentage of total retail sales. So I think Canada's trajectory is pretty clear. It's going to follow the rest of the world. And I say that, and the backdrop is also informed by our leasing folks at Oxford who give me their perspective all the time. And I think there's unanimity there that they would say the retail market bottomed, in their opinion, about 6 months ago. retailers of all types are growing again, and we are definitely going through a period of stealing market share from some property types that are just not going to make the trip to winners who are going to make the trip. And that's a period of intense competition. It's capitally intensive, and I think if you are not on the winning end of that proposition, you better think about alternative uses and redevelopment. And if you are on the winning side of that proposition, I think you just keep going. So there are other markets that you can look to see that the high street and retail is still going to exist, even in a world where we will have perhaps double the amount of online penetration. But the evolution of the marketplace through that is uneven. There are winners and there are losers.
Sure. Well, and as we're talking about evolution, and Fung, you touched on this as well in your opening remarks. We're seeing a number of individuals talking about reskilling and retooling their employees, and you talked about data analytics being one area. Any thoughts in terms of how data analytics or predictive analytics are going to impact your business going forward?
Well, I think the answer is it already has today, and we think that we see it playing a greater role and greater focus going forward. We have vast amounts of data that we use, from the simplest forms, putting it up on a platform, letting our clients access and view it, to much more sophisticated uses like indexing and modeling and AVMs. So we kind of see ourselves well positioned as a leader of sorts to help the industry and the users use that data in a more meaningful way. And I would argue, real estate has been somewhat slower than other industries in kind of embracing and adopting the use of data to its full potential. And I think, if we think about it in terms of the crawl, walk, run, we've kind of been in that crawl stage for a long period, and some of that was because we went through a long period of nothing but growth and gains, and everybody made money, and there weren't any real major pains along the way. A few hiccups, but nothing really major. But things have changed. The market's changed. The competitive landscape in real estate has changed. Deals are harder to come by. So the need for data, I think, is more vital now, and I think the industry is now at that walk stage, and pretty soon we're going to be off and running. And I think we're in a great spot to lead that, and the industry is going to require good, clean data, not perfect data per se, but good, clean data. And the data, the analytics are going to be a way to move the industry forward. So I think we're in a great spot, and I think data will become, to the quote that was in the report, data is going to become a much, much bigger part of everybody's business.
No, absolutely.
I can think of already 5 or 8 ways that we are using predictive analytics already in daily operations. So the industry is catching on, and a challenge for us is just the skill set required to do this. You can all sit up here and say, the world's going to be X, Y, and Z. Well, for those of us who've never done this before, we have to figure out how to do it.
No, absolutely. I mean, I know at PwC we're dealing with the same thing. So data is king, and it's really understanding how can you utilize that data and leverage it in order to be have that competitive advantage, which is definitely a challenge.
It's also about having good, solid data governance that underpins it, right? And that's what we're investing heavily in that as well, to make sure that that is supportive of the data that's out there.
Absolutely. So, Michael, I want to touch on something that you just brought up, and that's kind of that reskilling and the retooling of the staff to make sure that this data that you have, as an example, can be morphed and can be analyzed in a way that is meaningful for those that are making key business decisions. From the panel, are there ways that you're kind of looking at this and kind of saying, you know what, I really got to retool or reskill some of our people? Because it hasn't come up as an emerging trend at all, but wondering whether this potentially might be an emerging trend in a future ETRE publication.
I've found it's really hard to teach people entirely new skills. And I think a younger generation and coming into the workforce that are a lot more digitally savvy represent an opportunity to evolve the workforce. Millennials are 50% of today's workers. In 5 years' time, they will be 70%. And I think as certain segments of our employee base retire, they're going to be replaced by those who are just more technologically savvy. And that's likely how it'll be an evolution, as opposed to, I don't see us turning all of our leasing folks into data scientists. It's just not going to happen. I do see us putting people who have good tools and analytical skills and can manage large amounts of data being part of an embedded team and giving them insights in real time on opportunities and ways to create value.
Any thoughts from anyone else? George?
I think I actually would go back to the new era, new thinking, and that's kind of important here, and just the operational functions in real estate still are very world 1.0, and I think while real estate is a laggard, it's not immune to the disruption that's going to take place in jobs, and I think that the new thinking is going to need new skills. The new skills are going to require new jobs. And you look at R&D. If you look at R&D in different industries, R&D in computing and electronics is about 9% of revenue. So if you look at people who reinvent themselves all the time, look at that industry. I think, and I don't have the stat on real estate, but I think construction's 0.5% of revenue. So the amount of change, we have a dearth of those innovation skills in this industry, and you need to equip them. The question is going to be, who equips them? Is it the company's responsibility to provide those resources, those new skills, or is it the individual's responsibility to look after themselves and equipping themselves with those skills? I think that there's a void of those new skills that are there, and we need them, and we're going to have to solve for that in one of those two ways.
No, absolutely. One of the other kind of underlying themes that we heard from a number of our respondents is that the workforce is actually changing in terms of what they want. So they want more flexibility, they want to be able to work remotely, and that sort of thing. So, Michael, any thoughts in terms of, given some of these changes, along with we're seeing the phenomenons of the gig economy and the sharing economy coming out, how is that impacting, do you think, the need for real estate going forward?
I mean, was it 10 years ago we all heard everybody's going to work from home and they're not going to need to be in offices anymore? I see zero evidence of that. And if we pick a city around the world in which we operate, the trends are comparable everywhere, and a few themes are the same wherever we operate, which is real estate is about 8% of a typical company's P&L. It's a fraction of the cost of personnel. And there's a war for talent out there, and companies are seeing their space as a way to create employee engagement, employee productivity, express their brand, health and wellness, so on and so forth. I think that's good for the industry, for those who can embrace that trend. And the survey commentary and the survey results that Andrew spoke about speak volumes about the fact that that's what employees want, and that's what good owners and operators are responding to. So I think that phenomenon is going to continue and perhaps be further accelerated as more young people enter in the workforce, and they have significantly different preferences than today's 60-year-old.
Absolutely. So we talked about what the skill for, or the workforce of the future is really looking for. We've talked about the skills that they're going to need, where they're going to come from. Maybe that's a topic we'll talk about in next year's report. But we've also talked about affordability and people being able to afford to live in the city in which perhaps that they work, where their offices are. Cheryl, I'd like to hear some of your thoughts in terms of how do you ensure that you're attracting the right people to ensure that your organization continues to be successful going forward?
Well, there's no There's no question the cost of housing is making it more challenging to attract people. In my office, we're located in Markham, and people are commuting from places like Peterborough, Barrie, Guelph, Kitchener, and this is on a daily basis because this is where they can find the kind of housing they want at a price they can afford. And in most instances, this is ground-related, single-detached housing that they can't afford to buy in the closer in. So it's even more challenging when we're trying to hire people from outside of the GTA. The sticker shock really is alarming, and some folks, many more and more, are looking for relocation allowances for housing, even hotel allowances for those instances where they don't want to do the commute on a daily basis and perhaps stay in a couple of nights a week. So the shortage of affordable housing that we are experiencing really does have an impact on our competitiveness and our ability to attract people and businesses. The report noted over and over again that successful cities, the most successful cities, do have an ample supply of affordable housing. So it's not surprising that the Toronto Region Board of Trade and the Ontario Chamber of Commerce are begging for more housing.
Okay. George, did you want to add something?
Yeah, I think it's a challenge. I think, but when you look at some of the most innovative cities, they are the most expensive. Scarcity in some, and I'm not advocating we should have no affordable housing, but if you just observe it, innovation comes from some of those cities where you just don't have it. So look at San Francisco, look at New York, look at London. You'd argue, those are the real. Toronto's a great city. We're not there yet, and some of those have the same challenges, and it's not a unique thing, I think, for us here, but there's lessons to be learned, in scarcity.
No, absolutely. So Andy talked about in his presentation that he didn't think AI and the robots were going to replace all of us in the room. George, any thought whether that's true? It's just effectively going to help supplement our day-to-day job. Any thoughts on that, or should I be looking at a retirement exit strategy?
So if there's a hologram of Andy in the 41st version of ETRE, we'll know. Look, I think there's some really serious stuff ahead. And I was at a dinner one night, and we were talking about, they used the term, the holy trinity of technologies. And that kind of shocked me a bit, because that's an interesting way to think about it. And they talked about three. They talked about IoT, AI, and cloud. All-seeing, all-knowing, all-present technologies. And I laugh, but you go, this is actually coming true. We're in like a trillion sensor economy with pumping out data that a human has no hope of analyzing. You need a machine to process this stuff. So I think you're going to see, technology do what it's always done, perhaps at an accelerating level, is wipe out jobs at the low end of that skill ladder and add new ones at the top. And if you're not into that evolutionary ability, you're going to be a casualty. And unfortunately, as a society, we look at this, and there's a lot of economic job casualties in the world, and that kind of plays to political undertones. So we really have to pay attention to this, and I think the best solution here is equip yourself for the changes that are ahead. They're here.
Absolutely. So it sounds like flexibility may help some of the individuals reinvent themselves if they want to continue to be relevant.
Yeah, learning.
Any thoughts from anyone else on the panel?
Everything George says, I always agree with, so.
We need an easy button. That was easy.
Yeah.
Okay, so in terms of best bets, so Andy posted what we heard our respondents say were kind of the best bets and what are some of the topics that were top of mind. But I'm sure the audience would love to hear from our panelists. So in 1 or 2 minutes, if you had funds to invest in real estate, which asset class would you invest it in, and where in the world would that asset be located? Michael, I'm going to start with you.
Yeah, I thought about this question last night, so I better believe it because we're just closing on a acquisition of a company in Australia. So If I said anything other than that, wrong answer.
Noted. Cheryl?
Oh, well, I'm big on Toronto. I think we have a vibrant world-class city region that we're blessed with, and it's going to be a continuation of being a magnet for people and capital. And housing, any kind of housing, we need all kinds of housing. In particular, I would say follow the millennials. They grew up in the burbs, and they're returning there to raise their families. They may be doing it 10 years later than their parents did, but it's a movement. I would focus on sustainability and conservation and technology that closes the gap between home and office. These are about saving time, cost, and the planet, and these are things that matter to millennials. So if we can fix our housing supply problem, and I'm confident that we will, we've got a real winner here.
Excellent. Fong?
Well, I'm big on Canada. I love Canada, and I'd be looking at anywhere close to transit. I think in real estate there are fundamentals that hold true regardless of market or conditions, and I think location is one of them. If we look at the top 10 best performing projects in Toronto for this year, for instance, in the GTA, they represented over a quarter of the total sales, and they all had one thing in common. They were located near a subway, a GO train, a streetcar or bus, or a major highway. Same thing in Vancouver with the top projects there. So, I believe if you have a great site and a great location with a product that the market needs and wants, and it's priced appropriately, you've already set yourself up for immense success. And it's not a secret sauce. It's not anything that's earth-shattering, but it comes down to how well you execute on that. So.
Excellent. George, I'm going to give you the last word.
So mine is simple but different. I would am investing in a new asset class of prop tech. Doing that here in Canada, and what that means is you invest in people and ideas, and you build great companies that are going to solve some of the biggest problems we have in real estate. And so for people, if you are all inspired, r-labs.ca, get connected. Seriously, the best way to predict our future and yours is to help create it. So that's what I'm investing in.
I'll get that website from you later, George. So as we wrap up today, we have covered quite a bit of ground. If I were to summarize it into three major themes, I'd say we've talked about affordability, we've talked about prop tech, as well as the war on talent. So I just want to thank our panelists for joining us today and for sharing their insights. And with that, I will turn it back over to Richard.
Well, great job, Nadia. You got us through in good time, so we're going to give some of that of your morning back to you. Very quickly, though, just to wrap up, I want to just extend a few thank yous. Thank you, first of all, to Andy Warren, once again, coming up to Toronto to deliver a really great presentation. You've become an institution in this city. Thank you very much, Andy. Nadia, of course, and the PwC team who produced an incredible report year in, year out. I quite agree, 40 years, you start to get things really well. The Canadian chapter is now, I think, roughly 14 years or so, 14, 15 years. It's just become an indispensable tool for our industry. Michael, Cheryl, Fong, George, thank you very much for doing this, very generous of your time. Quite a bit goes in before this as well as today, this morning, so thank you for that. I want to thank our annual sponsors, our many table sponsors, and all of you for taking the time this morning. It's much appreciated. I do hope that a number of you will be able to come to our Toronto Urbanism Symposium. It's a very, very important event for us, as I mentioned earlier, with a longer horizon to 2020 with our spring meeting. We're really, really wanting to, as ULI, be ready to host the world, and I hope you can help us do that. So thank you again, and have a great Friday and nice weekend. All the best.